The infinite banking concept revisited. That's today's show. Let's dive into it. Hey, freedom fighters. Welcome to the Investing in Real Estate podcast. I am Clayton Morris.
I'm Natali Morris.
And this is the show where we focus on buy and hold real estate, helping you create passive income so you can spend more time with your family and hopefully attaining financial freedom. And the vehicle that we use is real estate. There are so many different ways to buy real estate. There's so many different ways to invest in real estate. There's so many different mechanisms to use to investing in real estate. We've had a guest here on the show before. You might know MC Laubscher. He's a wealth strategist, educator, financial freedom fighter. He's the president and founder of Valhalla Wealth Financial, and he is an expert in the infinite banking concept. Now, MC, I think, joined us last year here on the show. We've had a number of conversations offline over the past year, and we wanted to have MC back on the show. Why, Natali? Because I guess we've had a lot of questions, right?
Right. Okay, so Clayton, as a broadcaster, used to joke that if you really wanted to get people to write you about the segments that you were doing, like viewers, then you had to do a segment about pot or pit bulls, because that really riles up the viewers. But I'm going to add life insurance into that list, because we've had a lot of people write us with either questions or opinions or I don't know. I'm sure you already know that the industry has a stigma attached to it, just like real estate. But I think that there's still so much that most of us don't understand. And so people write us some complicated questions. I'm like, I don't know. I just read 2 or 3 books, and that's all I can say. And, I was looking through your policies that you had sent us, and I'm still trying to wrap my head around them. I've had a lot of travel this week. That's why I owe you some response time on that. But we thought, okay, well, let's just go to the horse's mouth. So thank you for being our horse today.
Thank you so much for having me on. And it's funny when you mention that it absolutely does have a stigma. If we look at a lot of really great comedy movies, they always sort of feel sorry for the guy that's selling life insurance and poking fun at him.
Isn't that Willie Loman? I think he's a life insurance salesman, right?
Yeah, I believe so. So there's definitely a stigma around this, and a lot of different varying opinions. So, I mean, I believe it was Will Rogers that once said, the problem with people isn't what they don't know, it's what they think they do know that just ain't so. And insurance is one of those segments where it's such a big industry. There's so many different strategies and so forth. So definitely something to consider.
Yeah.
Yeah, so we had a lot of questions. I mean, and there's so many, as you were talking to Natali, I guess, over the past couple of months, there were so many different things that, like you talked about with, there's not a one-size-fits-all approach to this. So one person's experience may be totally different than somebody else's experience, right?
Yeah, absolutely. And it all depends on insurance writers too, and insurance professionals that you're involved with. I think there's a lot of people and I've seen all of these comments online too, and read up about them. And so I figured I just share a couple of things that people that might have read the book, Becoming Your Own Banker, or done the research on infinite banking, some of the things that they might have run into, and they've gotten a policy and it wasn't as promised, and they kind of have a bad taste in their mouth. And I think one of the biggest risks, because we have to look at risk when you evaluate anything, right? One of the biggest things is it's probably not set up with the right company. It was probably not set up correctly with the right agent that knows how to set it up or is familiar with the strategy. And that kind of ties into a little bit more high-level planning. I've had people that reached out to me because I've spoken about it and sharing this. So I've gotten an email and saying, this wasn't as promised, blah, 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 blah. And then looking into it is this person listened to someone share the strategy on a podcast or a show such as this. They went to just any life insurance professional. The person had no idea how to structure it, how to set it up, or with the right company. So they're not getting the outcomes that they wanted or have it set up the proper way. So I think that was one of the biggest things that I've seen if we look at risks and mistakes around this. And that gets a lot of people pretty heated when this does come into discussion.
Okay, so for anyone who is just joining us and hasn't been through the various stages that we've been through trying to learn this concept, let's just give a brief overview that whole life insurance used as infinite banking is a way for you to pay into what is sort of a mix of a savings account and a life insurance policy that you have forever. And it gives you the ability to take out up to 90% of the money that you've contributed into that account in order to lend to yourself. Do I have that right?
Yeah. So what it basically is it's an insurance policy structured a very specific way in the plan design. There's a lot of moving parts. This isn't just straight whole life, to use that phrase. So it's designed in a very, very specific way with a mutual insurance carrier, a very specific one, because that's another pitfall. Mutual insurance companies, the ones that are utilized for this strategy, they've been around for almost 200 years. They have a very sound track record. Mutual insurance companies are not listed on the stock exchanges. They are managed on behalf of the shareholders of the company, which is the policy holder. So interests are aligned. Very, very important part that. And then to your point, Natalie, that yes, it's funded. There's an insurance portion of it. There's a savings element to it. It's also known as high cash value life insurance. That term has been put out there as well. So it's structured a little bit differently. But yeah, you have then the ability to borrow against your cash value, the accumulated, and some companies allow up to 90% of the cash value of the policy to be borrowed from, and then you can then utilize that money to invest in real estate. If there's debt that needs to be paid off, college funding. It's important also to just put it in there that this is not something that this isn't a 401k or a Roth. You have full control over this policy. You have control of what you want to utilize it for. There's no restrictions on the use where, for instance, with a 529 plan, you're only allowed to use it for education. This could be utilized for people have used it for vacations, for car payments, and so forth. I like to use it a lot for real estate investing in real estate.
So, one of the things that I think you might hear when someone tells you this, and I'm trying to sort of struggle with myself where I'm like, is this short-sighted or is this the way you should see it? Is that if I want to say borrow 50,000, I have to save 60,000, right? Because you always have to put in more than you can actually use. So how do you sort of wrap your head around that?
Yeah. So, and it's a mindset thing. This is the important thing to note that the mindset of wealthy people is they don't think in 6 months or a year or 2 years or 3 years or 4. They think in terms of decades, basically. So this is a strategy that isn't a get rich quick scheme. It's a very diligent way to build up. And as you mentioned, there's a load on this policy initially up front. But then you basically not recapture, but there's a break-even point in the policy for to use that term where after a couple of years, you've put in, say, for instance, $150,000 in the policy. There's no over $150,000 available in cash value, and the policy keeps growing from them and so forth. But yeah, it's initially there's a load where there is insurance costs. This is an insurance policy, a life insurance policy. There are different strategies of how we design these, or how to reduce and limit insurance costs, which is important to note. You're not building the whole thing on whole life. That's one mistake that I've seen a lot of people make out there when they just go to just a regular insurance professional. So there's many different things that we build this plan on and with riders, to use a technical term, but not to get too technical. But yeah, then if you're going down the year and you're looking in 10 years from now, 15 years from now, 20 years from now, 30 years from now, to where to warehouse your wealth and to hold your money, it's a very powerful strategy. And I just want to use the word strategy and processes and systems because that's how wealthy families and individuals think as well. They don't think in terms of necessary products. We've kind of been indoctrinated a little bit with Wall Street to think of shiny little objects, and we're always chasing the next product. This is, first you have your goals, which you and Clayton have covered on the show, and then you put processes and systems in place to achieve those goals. This forms part of that processes and systems.
So as far as the interest goes, I mean, that's where I guess some of our investors are curious about, okay, so how does the interest work? Am I making any money off of this? Does the interest come back to me? How does that structure? And how do you address those questions?
Yeah, that's a great question. So as a holder of these policies with mutual insurance companies, there's a guaranteed portion of your principal's obviously guaranteed, and then there's a guaranteed portion of growth. Some of them differ, but let's just say a baseline is 4%. Then because you are a shareholder in that company, when big, large mutual insurance companies are profitable, the shareholders, which is the policyholders, get to participate in the dividends. Now, dividends are not guaranteed, and dividends isn't just one number flat across the board, right, every single year. It depends on the overall performance of the company. Again, very important with which company this is. And then those dividends are then paid to the policyholders. Now, again, you have to take a step back. This is a chassis of whole life insurance designed a specific way. It's not apples to apples. When you say that let's just use 6%, because it ranges between 6 and 7%, but let's just use 6% of dividends that's paid out. The 6% is paid into it, but there are insurance costs involved as well. So I know that people run a lot of numbers in their head right away. It's more important to take a look at it from the product standpoint. There's many moving parts, different riders and so forth. But that's how they get access to or get these dividends paid out to them. And it's paid annually, which means if you're starting a policy and you're looking to invest within the first year, right, which you can, and you access that money, the dividends are paid at your policy anniversary. So today, boy, this year's flown. Let's just say it's 26 October today. We're recording this. The policy was issued today. Your anniversary is the following year, the 26th of October. So that's when the dividends are paid. So it's important to note that as well.
Okay. And then one thing that I'm still struggling with understanding is, let's pretend that we've decided that for me, we're going to start a policy on me. I'm 39 years old. I'm very healthy. I have 3 kids. And so we come around to the fact that it would cost, let's say, $1,000 a month as a premium. Okay.
Yeah.
So do I have to pay that forever?
For the health insurance premium. So yes, there's a base policy premium that's structured, right, that we built into this plan. We have differently structured plans for everyone, so it's a case by case. But there are, say for instance, you are looking to fund that up until age 65, then it's paid up, quote unquote, at 65. There's 10 pay plans. There's 20 pay plans. There's different structures of these vehicles with different companies. So, for instance, I usually share that there's different strategies for someone that starts at age 21 than for someone that's in their 30s and 40s than for someone that's in their 50s, 60s, and 70s. All of them can utilize this as part of their wealth strategy, depending on what outcomes they're looking for, and what problem they're trying to solve. But yeah, to your point, you're healthy right now, and you're 39 years old, so you'll get a pretty good base policy premium, which that premium, it doesn't go up as you get older. So it's not also the Wall Street under assets under management kind of structure where as the money grows in
like
there,
I'm grandmothered in to this rate, right?
Right.
Okay. Yeah. And then if I want to stop paying it when it's fully funded, then it's just, that's it? It's done?
Yeah, depending on the structure that you have, a 10 pay, a 20 pay, if you're paying it up to 65, there's different ways that we can quote unquote stop paying it. There's, for instance, strategies that we show of people that have started this, but then that now that their success is better than expected. So they go, well, I don't like to keep funding this right now. My system's up and nice. I've got some nice passive income coming in. I don't like to keep paying it. So there's options of taking the dividends then, for instance, and having the dividends pay the base policy premium and so forth. So it gets a little bit more technical, but I think what I want to drive home for folks listening to this and watching this, that there's different strategies of how to while you have the policy, of how to get it paid up and utilize it.
One of the questions that I know Natalie had said before on one of our podcasts was about the children and utilizing your children and setting up a policy for your children in order to have their own policy that when she turns 16, that she can just use her policy to loan herself money to buy a car, etc. But one of our investors had written and said, but think about this. Even in the best case scenario, your daughter would be paying a 3.75% interest rate to the bank that collateralizes her whole life policy. But is that a good deal? I don't know about you, but my last car loan was 1.9% interest rate. So what do you say about that? The naysayers about the difference in interest rates there. Is that valid?
Yeah, so how these insurance companies work is that there's a pool of money in their general account that they set aside for policy loans. So, for instance, right now it's around about 5% if you borrow against it. Now, absolutely, can you get a better rate than 5% out now in the marketplace? Absolutely. There's a couple of things to consider, and I know people will probably run a ton of different numbers, and I'll be interested to see the comments on this as well. The first thing to take into account is insurance traditionally has been a pooling of resources. We're all pooling our resources together. It's been the bedrock of society, really, of taking care of families. It's done the same way in the general account. So I just wanted to clarify this because there's a lot of confusion on the internet about this as well, and people are making very bold claims and people arguing for and against. When you borrow take a policy loan, it's from this general account. It's not from your policy, number one. And when you pay back the interest, it is not paid directly into your policy. It's paid into the general account of the insurance company, where we're all pooling resources. Now, this general account ties into the profitability of the mutual insurance company, which then distributes it indirectly in the form of dividends at the end of the year. So it's not directly credited. I just wanted to mention that as well. But yeah, so to address your question directly, when you purchase, for instance, that car, when you borrow at 5%, can you borrow at a cheaper rate? Absolutely. You're still getting the growth in the policy right there, because there's a couple of different ways to purchase something. We could purchase that car cash. The cash is gone. We have the car. Now the opportunity cost is gone for that money. So by having the money in the policy, still growing at a predictable rate, still earning dividends on the one hand of it, borrowing at 5% and then paying it back, there's also two other factors at play, and this is something that we could run numbers on this, different numbers, but there's compounding interest on the one end, and then there's a principal that's being paid down on a monthly basis and interest on the other end. So when you look at certain ways of doing it in specific situations, you do still come out ahead by purchasing the car in such a manner. And again, I'm happy to hear the comments. There's different ways of numbers there, but yeah, in the specific cases, you do still come out ahead. The other thing, and you talked about children's plans. It's so important. I have a 5-month-old son. He already has a policy set up for him, and what it does is basically structuring something, positioning him, putting a savings plan together for him. That's his money. That's not in the casino in Wall Street, that we still as parents have full control over, growing nicely and predictable. When he's 16, there will be money in there for him to purchase a car. The lessons that go along with it as well, teaching him how to borrowing it, paying it back, showing him the numbers, why we do this, how we capture our wealth in our own economy. And then, for instance, with my son, he's going to have to pay that back before we go into the next phase, which is college, which the money will be there for him as well to go into. So that's another thing. And then as it progresses, through his life what he will have in place. And at that stage, there's a death benefit as well for him. For him and his family, there'll be money in there to purchase a home, for instance, or invest in real estate. And when he's 60, 65, I know that my son, the back end of that is already taken care of as well, which is, I mean, it's extremely powerful and empowering families and people to do it in such a manner. And for children, I mean, that's one of the things that I find I get a lot of professional, I'm grateful every time I'll be able to do that for someone, just because I see the massive changes that you will do in a child's life.
Now, can you talk to us a little bit about shopping for these products? Because, I read these books and I was like, okay, let me go online. And that's not a good way to go because you can't tell which insurance products are going to allow you to borrow from them and which ones are not.
Very, very good question. So what I would say is there's a couple of really great organizations in the United States that train specific life insurance and financial professionals of how to structure these plans, and also provide coaching for their prospective clients. And one group that I'm part of too is the Infinite Banking Practitioners Group. It's the Nelson Nash Institute. If you're working with a professional from that institute and that association, you know that they know how to structure these plans. They know with which companies to structure these plans and make sure that it's set up correctly. There are other groups as well. Prosperity Economics is a great group that's doing fantastic work in that field out there. Some folks might have come across Bank on Yourself, also some really good value that they offer. And then there's also there's a group called the Wealth Factory, which is also kind of focus around that. It's all high cash value life insurance structured a specific way. These people have gone and taken on additional training, coaching, education, so they know how to set up these plans correctly and with the right company. So I would feel very, very comfortable if any of your listeners reach out to any of those professionals of some of those groups that I've just mentioned and start a conversation with them. They'll be able to help you and guide you in the right way and have these set up correctly. They'll also be able to share some resources. So a big part of this is education and teaching, because it is a mindset shift, right? It's the Robert Kiyosaki philosophy of we all have the exact same amount of asset classes we can invest in. We can invest in them as poor and middle class folks, or how the wealthy invest in them. Insurance is just another vehicle. It's the same thing where there's, not all policies are equal. Not all strategies are equal. I'll give you an example. Well, if we look at the tax code, the IRS code, there's a lot of similarities between insurance and actually between real estate. I mean, I kind of chuckled the first time I saw this. I'll give you a good example. In real estate, we have a 1031 exchange that I know you guys have covered. In insurance, there's a 1035 exchange. So these vehicles dovetail really nicely because the wealthiest families use them and know how to utilize them, and also have a team around them of professionals and advisors that know how to structure them properly.
Wow. Well, great stuff. And sorry to throw you to the wolves today, MC, but we no one better to answer some of these more difficult questions that have been coming in since our last episode. And God, I know we have a ton more questions, so we'll have to have you back for round 3 and round 4 as more people fire their questions into us. So
maybe we'll throw in some questions about pot and pit bulls if you want to.
Yeah, we can add that too. MC, how can people get a hold of you?
Yeah, so I think they could go to cashflowninja.com. Is also one of my podcasts on there. There is a webinar with where I actually have taken a bunch of questions and compiled them into this. It's at cashflowninja.com/be the bank. ValhallaWealth.com is my homepage for my company. It's a little harder to spell, so that's why I direct people a lot to the cashflowninja.com/be the bank. It's a little bit of an easier URL to get to, but I really appreciate your time and having me on. And I've seen a lot of emotions on the comments. I'll be happy to review them again, and if there's any other questions, I'll be happy to come on and address them again.
Perfect. Well, MC, it's been our pleasure. Yeah, thank you so much for joining us today. We really appreciate it. Thanks so much, MC.
Thank you so much for having me on.
And thanks to all of you for downloading and subscribing and getting heated around pot, pit bulls, and life insurance and sending us your most interesting questions today on this show. We'll be back with another episode of the Investing in Real Estate show. I don't care if you use life insurance. I don't care if you use cash. I don't care how you do it. Go out there and take action and become a real estate investor. We'll see you next time, everyone.
Bye.